What is going on, everybody? We are trying a new show for you this week and for the next 4 weeks. And by we, I mean David Ramsden-Wood, obviously I'm talking, but the one, the only, my man, Mark Rossano. Mark, what's going on today?
Not much. There's a lot of stuff going on with on Capitol Hill now that we have Yellen speaking during her confirmation, and just and she's really kind of laying out, I think, what is going to happen going forward. What are her views? What is Biden's views? And when we're looking at not only China, but also how are we going to continue to try to stimulate the economy? And there's a lot of commentary about the dollar. What does that mean? 50-year bonds just got thrown out there. So there's a lot of unknowns.
So we are going to be talking about all of it. So for listeners, this is what we're doing. If you don't follow Mark Rossano on Twitter, he still is not objecting to Twitter like I am. And if you don't follow me on LinkedIn, you may miss every week. Mark and Primary Vision come out with a phenomenal amount of data. It's about an hour and a half, 2-hour video, but they talk energy, they talk the economy, they talk macro, they talk China. Mark was one of the first people talking about the Three Gorges Dam in China and the impact of that flooding on crops, which was going to inevitably lead to food price increases, which we've seen. He talks inflation, he talks US dollars. So this is the DRW Mark Rossano pre-game show to set you up for the things that you need to know so that you can go in the next hour, 45 minutes. You're going to hear all of what you're going to see that Mark is going to go much more in depth on his show. The links are going to be in the bottom. And so that way you can have, if you only have 45 minutes, this will tee you up. And if there's a topic that's super interesting to you, boom, you can dive right in. We're going to try it for the next 4 weeks. We want listeners to weigh in and tell us what we're doing well and what we can do better. And we're just going to let it roll. So, Mark, you talked about Yellen. There's been a massive change in sentiment on the US dollar with Biden winning, Trump losing, Capitol Hill's riots, Senate runoff in Georgia on the 5th, and then now Yellen being confirmed today, and as you said, throwing out the word 50-year bonds. So let's start on US dollar, inflation, and then we'll go to China. Well, where are we at?
Yeah, the biggest thing right now is going to be, what does Yellen say? So right now she's talking about maintaining a dollar float, which I think is something that was pretty much expected, and the need to maintain a certain steady course of not only easing but supportive monetary policy, and given her stay as the Fed chair, but also as we look not only into monetary but now fiscal. So she's really talking about maintaining the fiscal support, and she's essentially elaborated on how she's going to build out a second type of stimulus deal. So that none of that is really surprising. It's always going to come down to, well, how big and what is that going to look like? So right now, when we look at the dollar, it's essentially holding some of the losses, but again, the dollar is now being driven way more by China and what's happening in Europe and the euro. So because a lot of the things that she's saying is really been priced in, there's a lot of there's really no surprises. The biggest component, which is I think where a lot of people were concerned, is how is Biden and Yellen and that's more of a political, and then on a fiscal side, how are they going to tackle China? And she really kind of reiterated what we all thought, or at least what we've been saying on the show, that Biden's going to remain tough on China. We're not going to deviate from the current plan. We might soften some of the rhetoric, but the actions themselves really won't be adjusting all that much.
So Mark, I'll raise my hand because I have a question. Now, last week we saw Biden come in with a $1.9 trillion stimulus package, which follows the almost $1 trillion stimulus package. I thought Congress was supposed to be the ones doing all the stimulus. What is going on with the Fed in terms of what Yellen now wants more stimulus? Like, when is the Fed, are these elected officials and I just missed it on my ballot, or no?
So the whole commentary now is that we're going to have monetary policy remain easy. They're essentially going to maintain anywhere from, let's call it 120 to 140 billion dollars worth of purchasing through the end of the year, at least based on what we've seen so far. On Yellen's side, it's a matter of getting money into people's hands and trying to find creative ways to do that. And we saw with Mnuchin how he pulled some of that money back. from the Fed. So there, and now it's locked back in Congress. And the idea was that this was going to, stymie some of that spending. But now with the Democrats, pretty much a clean sweep across the board, we should see another type of package coming through. That's going to be another round of PPP. It's going to be another round of small business loans, probably get another one-time check. But I think more importantly, it's going to be, what does unemployment look like? And then what do the backdrop on housing, rent, forbearance, and bankruptcies really look like as we go through year end, which is something that I think is some people are concerned about when we're looking at, the most recent bank earnings, where what is bad debt expense? What should it be? If you don't have to pay your mortgage or your loan or your bond because, you can't have something get pushed on you from the banking side, are people going to be bad actors? Are they just going to let this ride until all of a sudden they're like, oh, sorry, and then they declare bankruptcy? So there's a lot of unknowns on the banking side as well.
So it feels like there's a lot of complications because we're at all-time highs. Investors are super bullish on the ultimate snapback. I've been hearing more and more. Obviously, you're a bear. I'm a bear. Timing is everything, but the number of people that I've heard say, millennials, there's 80 million millennials who the oldest one just turned 40, and they are ready to get out of their house. They are ready to travel. They are ready to absolutely rage. And last week we saw 4,500 coronavirus deaths reported in the United States on January 12th. Not only did the market go up, but like nobody cares. And so how do you balance the economics of rent forbearance, mortgage forbearance, people are losing their jobs, unemployment stays high, we continue rolling lockdowns, and then at the same time we have this, but we're looking 9 months out and everyone is ready to spend dollars, so that's why the market is all-time highs, but the Fed's just going to help keep interest rates low to manage inflation expectations. Like, that's a lot to unpack there. Break it down for us in 30 seconds. What is the thing that we need to watch the next 6 months more than anything, in your opinion?
Yeah, the two things. So just to be clear, you can be bearish but not positioned as bearish because, we're all trying to make money and survive. But when we're looking at this, for us, it's going to be wages and jobs, because that's where we saw a lot of the cracks starting to form. And that's why we look at leading indicators, including PMI. The New York Fed has their weekly indicators. And we try to look at those leading indicators. And some of them you might say, well, why jobs? Because jobs is a lagging indicator. Well, we look at that as a little differently, because as you have these individuals who are now out of work 26, 29, 30 weeks, you start to get a little antsy on, well, when am I going to get a job? And then you start to take, the underemployment rate, or you accept a job that maybe is well below or below where you were previously. And then that's going to impact your real spending, especially as we have inflation going up, because, as we like to talk about, inflation is going up in some places, but there's deflation in others. And where is the inflation centered? Well, it's centered around where people are actually buying their stuff on a day-to-day basis. And as you have wage pressure coming in, those prices going up, you're going to miss out on some of that discretionary spending.
Okay, so people can learn more about this when you talk macroeconomics in your economics show. And as a secondary piece to this, because obviously there's a whole bunch going on in the US, and I don't want to sound like a conspiracy theorist, which is the most weaponized word that there could possibly be. Whenever you question a narrative, they're like, no, that can't be. But I remember in 2019 when we first met, we were involved in a trade war with China. And at the beginning, about 365 days ago, you were really focused on what was going on with coronavirus. I was sloughing it off because they said, well, there's 45 people a day dying in a country of 1.3 billion. How big a deal can this be? Apparently, it can be a very large deal. But it looks like China is back. Asia is back. The economy is roaring. They had one new death over the weekend from coronavirus. Sure, 26 million people are locked down, but that's what China does. So how do I integrate what's going on with the China data as opposed to the US, where we think we have a lot of transparency into the data? We're just sort of ignoring it.
Well, China has been really good at restriking previous numbers, and one of the biggest ones that they do that is on the investment side. And if we go back to 2010, you can see where they initially published, where they restruck the information, and then where they did it again. And you can see that they keep adjusting the data lower and lower to make the year over year look better. And the biggest problem, and something that we've been harping on nonstop, is a supply recovery versus demand recovery. Because when you look at the data overall and you look at China specifically, the demand isn't there. The consumer has not come back and remains very weak overall. So the bigger issue when we look at Lunar New Year and what does that mean? So right now they're up to about 53 million people that have some form of restrictions placed on them, with about 27 million that are in utter lockdown. And the issue is Lunar New Year, which is the largest migration of people throughout all of the world on a 30-day basis, and it's when people go back home essentially. So you have urban migrant workers going back to their rural setting, and that's the issue, because when you look at where the spread isn't really in the urban side; it's on the more rural side, which becomes a problem, because if people go home, are they going to catch it? Then they're going to come back, and that's why you can say, well, they're gonna play this up because the data is not that good, and by locking people home or restricting movements, they have an excuse on why some of the data is going to miss. Or they're just going to be cautious and want to make sure that they don't have the same type of increases that we've seen, because Indonesia has had a spike in cases, which is becoming problematic. Korea, Japan still have their increases, and they're seeing some of their data slow. While India had started, they've had a pretty steady decline, and that's now starting to flatten out, where they had a net increase in cases. But so far, I think India is an interesting one to watch, because they've been managing things pretty well. But they have seen a pretty big drop, about 6.6% so far through the first half of January on their diesel demand, which could point to some bigger problems in the economy.
So history doesn't repeat, but it rhymes. And it's amazing to me that if you go back 365 days and you look at this, the stock market's basically it was at all-time highs then, it's at all-time highs now. There's this virus thing in the peak of virus season that has questionable demand impacts. China's managing numbers, so we don't necessarily have a thing. And people are, other than that we're all wearing masks, I would say generally speaking, people don't seem that worried about it. And again, I think it's very, I'll use the most extreme example. I was at a that shall be unnamed restaurant in Midland where I went in wearing a mask. And as people know, I may be a little reluctant on the mask front. But I went in and they said, you're going to need to take that off to come in here, which would be the one extreme. And then New York has a different extreme. But all of these factors are building to how are we going to deal with coronavirus? And we've seen the Moderna vaccine, which was pounded through, has worries in California. We saw the Pfizer vaccine in Norway, which has worries with injecting with old people. 23 people died. And the Norwegian government, the health authority came out and said, well, if you're old and near the end of your life, you probably just shouldn't take it because it's not going to help. Which if they had said that last year, or Cuomo when he was like, every life matters, and then he tweeted, well, we need to open the economy, otherwise nothing's going to be open. So I'm curious how your gut feeling is around, is the world at all positioned for anything negative? And what is that negative catalyst that would make people go, holy cow, we got to do something different? Or are we just saying lockdown should never have been done? We'll just keep wearing masks, people die, carry on with their life. Where are we at?
I think we've come to a point of exhaustion where people are tired of lockdowns. They're already starting to go about their business a bit more, which is why we've been looking at gasoline data and toll road data, more and more, just to see, okay, well, if we look at what durable goods have done, we've seen a ton of new cars being purchased. We've seen used car prices explode. We've seen a huge movement as we've gone from that urban to suburban setting, as you can look at housing data, mortgage data, car data. So we've seen the pivot. If you had the ability to move, you moved. And now, as you've talked about, people are feeling a little bit better. Maybe you're not going to Target, 3 days a week, but you're going once a week, and you're starting to see some of that movement. But yet the gasoline data isn't reflecting a lot of this increase. It's still well below seasonal averages, which is why we start to take a step back and say, okay, well, how is spending changed? And is it going to permanently change as people do a little bit more? We still have work from home. You still have people avoiding mass transit and the office. And I think the biggest thing is going to see, okay, well, how much is work from home going to be sticky? How much of this blended schedule that everybody seems to want based on all the data becomes the new norm? And then you don't have gasoline data going back to where it was. You don't have oil prices going back to those highs because demand is just shaved in general. And those are going to be the different pieces that we're going to watch for, especially as you have this uncertainty in Europe as what is the effectiveness of lockdowns? What does the economy look like on a recovery level? Just because, as we've talked before, 2019 into 2020 was just a forest fire. COVID was just jet fuel on that fire. Where when we looked at leading indicators, when we looked at trade, when we looked at all of these things, we're like, 2020 is going to be a bad year. And then COVID hit. And if anything, maybe it kind of glossed over some of the problems because it freed up central banks to do a lot of printing. It freed up, a lot of governments to issue a ton of debt and stimulus. And all of a sudden, now as we try to come out of this, it's like, well, am I getting that job back? And we've said from the beginning, no, you're not. Like people used COVID as a means of letting people go because it was the excuse. It was, oh, sorry. Well, you don't get a vaccine, a job, and $10,000 cash. Like that's not how this is going to work. So we think that recovery is going to take a lot longer, and you're going to see that really kind of stretch out, not just in the U.S. but on a global level.
And so you can learn more about the China show, and I think that learn more about China in the deep dive that Mark will do on China with a lot more of the numbers. What strikes me as interesting is everyone always says the market is forward looking 6 to 9 months, and you could argue that it's priced to perfection based on earnings ratios. I saw something earlier this morning that said tech companies that don't make money are like the valuations are so beyond stretched it's almost like it's crazy. But the bull thesis goes something like this, that all the spenders have been locked in their house. They're feeling more comfortable. We have 11 million doses of the vaccine that have already been given, so presumably they're going to follow up. Most of the healthcare workers have got it, so that reduces that risk. The elderly who feel like they're at risk, or the ones with comorbidities like obesity, diabetes, etc., they're kind of staying home. But the younger people, and I saw this on CNBC today, that there's now a lot more resistance to mask wearing on airplanes, for example. You're seeing a lot more people in public spaces pulling them down. You're seeing 26 million people have already had the virus and recovered. So in a way, 10% of the population of the total U.S., but then 70 million are kids who aren't really at risk, and 70 million are olds who are already staying home. You're kind of at this place where everyone is going to rip, and they want to go to restaurants, they want to go out, they want to spend. And if anything I learned from 2020, so here's the question. The bottom 50% of the economy aren't really the ones who drive the economy. They're the ones that work in the economy. And so all these workers that aren't going to get $10,000 for a job, they're living in rent. They don't own houses. They don't have huge jobs, and they're basically just the employees for the upper 50%, which is why we're trading at all-time highs. What do you make of that as the takeaway from 2020, and what debunks that theory? Because that is very, very much the bull thesis, in my opinion.
I think it comes down to that social immobility and the inequality that continues to gap. And we have in the show, we're going to go through where the top 20% have really seen 90% of the gains that especially when you look at the market, because the top 20% not only earn about 60% of the wages, but they also have gained about 90% of the cap gains that we've seen in the market in general. So again, it comes to this growing strife where even though they're a smaller part of discretionary spending, they still make up about 30% of spending in general. And if you look at the US GDP, 70 to 75% of GDP comes from that C, that very important consumer. And as you look at their spending habits and their feeling of, Yeah, let's just, what's the best way to put it? When you look at how they have now become more depressed, they've seen their standings, there's very little way forward in terms of wage growth, because where are we going to see more wage pressure? Well, we're going to see it in this part of the sector. And now if you look at the talk on an increase in $15 minimum wage, well, how much can I push that through to the consumer? So how much can I say, okay, well, this product is now going to cost 20% more, and am I going to cut hours? So maybe I had 3.5 workers, now I have 3, or maybe I had 2 workers, now I have 1.5. And you're going to start to see those hours start to come off, and that's where we structure and go back and forth, because they're so important to this baseline growth where, okay, they're not going to Disney World, they're not going to fly first class, and pretty much I don't think a lot of people are flying first class at this point. But when we look at just where is the health, where is the structure going to come from, there's going to be that lag. And unfortunately, if you look at just the growing immobility, the growing inequality, the growing resentment and anger, which we've seen lash out on both sides and both extremes in terrible ways, has become, I think, a growing problem with just how do we get to the other side and really start to get this mobility coming from and get this despair, going away and kind of focused back into work.
So this is not a political show. It is not going to be a political show. And I want to caveat that and say that, because there is a lot of things in terms of public policy that may be perceived as political, or statements around one side or the other that's perceived, but it's relevant. And you made the comment on, not many people are flying first class. I agree. I also have so many airline points that I can't use because I can't fly internationally, that I happen to get upgraded into first class, which, as it turns out, is the only place they serve booze on a plane. Which, when you talk about inequality and the frustration and the anger, we obviously saw it last summer in the BLM riots. I would parallel that with the Capitol riots. The BLM riots were very angry at police treatment, and in many cases, very, very bad police treatment. And they lashed out at the aggressor, which they viewed was the police. In January, regardless of what your view was, there's a lot of people who are very angry at the government, and they went to where they were angry. But you talk about the wealth gap, and you talk about the spread and where that allocation is going. And even just something as simple as, I can drink on an airplane when I'm in first class, but they can't trust the people in the back of the plane to act like reasonable people. Those little nuances. Do you see any civil unrest coming this summer that isn't racial, but it's wealth related? And then what does the incoming government do in terms of tax policy, since these lower income earning classes are getting dramatically poorer with wage depression, while everyone else is getting dramatically richer? How does that play out?
I think you're going to see a continuation of the problems, because they're not going away, and each side is angry for their own reasons, but they still are feeling, though, as they're left behind. There's no way where hard work, how much hard work can actually be rewarded, and if it's not rewarded, then what? How can we better ourselves and better our situation? And right now, I think that unrest is going to continue. The difference now just is something that we had in the 70s, which is something that we lacked in other periods of U.S. history, is we do have an external foe. And the external foe will remain China. And that's when you look at the narrative, how does that narrative shift, and what is going to create unity within the U.S.? And I think when you look at the way things are pivoting, not only Republicans, because Republicans, and we look at just the different sides, Republicans always viewed or have started to view China in a negative light. And that's only increased as well on the Democratic side. So you have the extremes or the AOCs of the world who say, this is not something we need to worry about, but it is. And if you think about Where have cheap jobs gone? Where have factories gone? Where have we seen a pivot? And it has been into China. And the question is, how much of that can pivot back? And then that comes into, well, what's energy policy? How do we incentivize and bring down cost? Because inherently, if you look at just the effective worker, the U.S. worker is very efficient. We are very efficient workers. We have a high working class in terms of just intellect. When you think about schooling, that lends itself to this growth. But again, it comes down to cost. And that's where, until we start to see that pivot and that narrative shifting of, hey, these guys are the problem, these guys continue to act, as bad actors, and we've seen the increase of freedom of navigation acts. And but to be clear, they happened under Obama's second term. We look at the pivot to China, we look at the freedom of navigation, we look at the IP Commission report, we look at the unity between India and Australia. That was all started under Obama. I mean, Biden was vice president. We're going to see that change? No. And he is more centrist than he is that left leaning. And I think we're going to start to see that focal point, and that's how they're going to massage the narrative, if you will, to kind of create unity at one entity.
So with so much going on and so much geopolitics and interplay and economies and policies and et cetera, how do you focus on the key 5 things that actually matter to really watch? And then I made a joke this morning with a guest on the podcast that if you had gone into a coma January 15th and just woke up yesterday and you were on the energy side, you would find that oil is kind of the same. The market's up 10%, which would have kind of been expected. Everything, it seems good. Narratives are intact around is demand being destructed or not, ESG. But it was only the people who weren't in a coma for the last 365 days, which I venture to say is everyone, that experienced all the pain. And there's so much information and narratives and media telling you things. How do you focus on the 5 things that you think are the most important? And how can people use those in their daily lives to make educated bets? And I'm not talking about buying stocks, selling stocks, because you'll never beat the market. I mean in terms of jobs, savings, protecting your family, protecting your mortgage, protecting your livelihood, stuff like that. What do you think about that?
The one of the things that we're really good at is finding correlations and finding the correlations that are going to matter most over the next, not only just the next 2 weeks, but also the next 6 months, 8 months, 10 months. Because when we're looking at things, we want to help corporate planning. The corporate planning, your stock price might go up or down 5% in the next week for reasons because you got caught in some momentum trade and your stock's going to explode. You had 30% short interest, and voila, all of a sudden you're up 20% in a month. That's something that we can try to find, and that's more of the trading side. But when we're looking at things, the biggest components, and when we look at turning an aircraft carrier, it's trade. Trade is very, very specific. There's very specific routes. We look at what is the price of the ship, what is on the boat, where is it going, how long has it been on the water, and these are very core things. Like right now, as I'm seeing things come across, Angola. So let's take oil for an example. West Africa is the first region to sell their crude. Angola sells a large part of their slate into China. Well, they now have more cargoes with additional price cuts. So we saw them cutting prices in the beginning of in the middle to end of December. We saw 3 new price cuts in January, and now they're reducing prices for their March loading, which is smaller than January and February. So why are they exporting less? If things are so good, why is it that a very high quality crude, which is medium sweet, which is kind of the Goldilocks crude, if you will, can't really find a home, or they're pricing themselves at a steeper and steeper discount? Now, it's still a premium versus other grades, but it's supposed to be. It's medium sweet. It can go anywhere. It can make anything. This is what you plug into the refiner. So those are things that we're looking at, is okay, well, where are prices going to follow, not only within the physical market, but then the paper market? And then when we start looking at, what is happening on the economy front, it's always going to be PMIs, pricing, new orders, And then we kind of fill in the gaps behind that, because again, those are surveys. Okay, surveys are nice, but what are we seeing on the ground? How many trucks are moving? How many rails are moving? And that, again, tying back to the boat, because we want to follow the whole supply chain, as we call it, well to wheel. We want to look at the full supply chain to find where are the cracks, where are the growths, because if somebody's losing money, somebody's typically making money. And you can try to find, okay, well, I'm going to short that, or I'm going to try to protect myself there, and I'm going to try to, like, how do I capture that growth? And that's why, like, we've been very adamant about our bullishness in propane, in LNG, and then that feeds into Southeast Asia. You know, we think that there's a lot of growth potential in Vietnam that's going to continue as we see this pivot away from China. And these are things that we're trying to find data points. Are we right? Are we wrong? Because luckily in this industry, you get daily, if not weekly or quarterly, just data points that are like, nope, Mark, you're an idiot. This has to shift. And I'm okay shifting, because again, like, we do try to be data dependent. You know, people that know me before 2014 think I'm a perma bull, and people that know me after 2014 think I'm a perma bear. It's just, I'm just going where the data is pointing me, and where do I think things are gonna really kind of shake out over the long term.
So that tees up energy. Let's talk about energy. I have had 3 conversations over the weekend with 3 people I respect a lot, and the I don't want to call it consensus because it's only 3 people, but I have never heard such a bull case for we are underestimating the demand recovery and the snapback and the roaring 20s, and that there's a fundamental supply issue, which is that, you know, inventories have come down. U.S. inventories are basically at the 5-year, you know, average levels. OECD are down. You know, we talk about products, we talk about Angola, we talk about Saudi cutting. Like, there's a whole bunch of bearish indicators, but like, I'm hearing guys be like, oil's hitting 65 this year, and Goldman Sachs is one of the most recent to come out and say it. How do you think through that in the backdrop of everything you just described, and what should people be thinking about on that energy, oil side first, then we'll do liquids, and then we'll do gas?
Right. So when we look at oil, we like to look at the demand drivers, and the demand drivers, who's the biggest demand driver but refiners. So when we look at refiners, we want to look at, okay, well, are they making money? If they're not making money, then why? Is it because there's no demand? Is it because storage is too high? Is it because crude is too high and they can't push through the pricing? And that's where we really try to start the conversation to look at what is happening at the refining level and where is their demand going? Is it domestic? Is it international? Like, when you look at India, for an example, India has 2 different types of refiners. One that essentially only turns really inward and sells to the local industry, and then you have several that are positioned to essentially be a huge exporting component and capture the floating market or the international market. And when you look at what's happening in India, things have recovered fairly well on the internal side, but the external exports remain weak in terms of where things are going, and pricing remains problematic. And that's where we like to seasonally adjust everything, because seasonally, you know, you can't talk energy without seasonally adjusting where are we right now. January is normally a slow period for driving. People are lethargic after their, 8 weeks of holidays. People are slow to come back. CapEx is starting to move around a bit. Well, it's slower than normal. Okay, well, what is the pace of recovery looking like so far? And the pace has been very sluggish, and it remains sluggish as you have, these competing headwinds. So when we look at sluggish data points on the high frequency side, on the mobility side, that leads us to, okay, well, refiners won't be able to sell their product. So if they can't sell their product, well, you're increasing oil prices, which means that they're going to try to buy less, or they're going to cut runs to try to protect their margin and try to essentially find a way to make money in the current differentials that are squeezing them. And India was out today talking about how they're confused by Saudi Arabia's moves. They're like, if anything, we need lower prices because you want us to do more, will help us make money and we can bring the cost down. And by doing that, we're going to incentivize people to do more because now the gas, you can fill your gas tank cheaper. You can do a lot of things cheaper, so you'll do more. But we're not seeing that. And that's where this view is. And I find those who are very bullish oil are looking at just oil, and people who are bearish oil tend to look more at the product side. And at some point, typically the product side will prove out to be correct. Again, not saying that you can't be wrong as well, but I just don't see this turnaround as the data shows. People have moved, people have bought cars. I'm not seeing the gasoline data shift in a way that shows me that they're doing anything other than aimlessly driving, maybe going to the store a little bit more, but really not consuming the way they have been in a pre-COVID world.
So if you layer all of that in on the oil world, are you feeling generally, I mean, oil has moved from 35, and I know you and I talked about this in the summer, and I think we were both of the view that December 31st, oil will be 35. Now, timing is everything, because it was about October 31st that oil was 35 and sentiment was horrible. Add in the election and vaccine, it went crazy. How do you think about oil going north of here and keeping running up because of US dollar concerns and all the bulls not looking at the demand data? And let's add that Saudi has very clearly made the point, by them unilaterally cutting 1 million barrels a day, they are in control, and they made up for their lost revenue because oil went from 48 to 53, and that's 10%. They cut 10%. They're good, and they're selling their own oil out of inventory. So that's the bull case. The bear case is we're seeing lockdowns, we're seeing slowdowns, we're not seeing moving. We're just not seeing the recovery, and products are everywhere. Who wins this tug of war?
It's always going to be the buyer, and the buyer is the refiner. And if the refiner says, you know what, I'm going to stop, or I'm going to slow down, because if you think about the refiners right now, they've already purchased what they're cracking right now. And if they purchase at January 19th, that crude won't see the inside of a refiner till April. So when we're looking at where things are going, you have to say, okay, well, what did Saudi Arabia do? And I think to the Bulls case, their idea was, well, we're going to get a big supply cut. Okay, well, what do we have at $53 WTI and $56 Brent? Well, you're starting to get kind of profitable in some of these areas. And especially when we start looking at tiebacks, when we start looking at some of the offshore, the exploration, if you will. And then if you look at the U.S., and now the question is going to be, what happens in the U.S.? So the first 12 months, the next 12 months, you can hedge over 50. So what are they going to do? They're going to immediately go out and say, okay, well, what can I get my hedges on at? Is it 51? Okay, I can hedge at 51. And then you look at, well, what kind of acreage do I have left? Do I have good acreage, poor acreage? Can I do a dual stimulation and bring down cost? And how am I going to protect my production? And I think at this price deck, 11 million barrels a day becomes a very doable line to hold. And I think if we saw another 12 months at $35, $40, you're not seeing 11 million barrels a day out of the U.S. You're seeing 8.5, 9. And now all of a sudden you can start to say, well, now we're starting to see some pain, and that's where then you can kind of turn back on. You can start to see some of that growth. And I think with that, again, I don't know what Saudi Arabia is doing, but they're coming back too soon. And Russia said it. They're like, oh, guys, please don't do this. You're going to give a lifeline. But yeah, at the same time, Russia, as I talked about, Senegal and Angola crude going at a discount. Euro prices are at a 1-month high. You have ESPO prices at a 2-month high. So Russia's like, all right, if you're going to do that, well, we'll benefit, and that's fine. You're going to help us, and that's great. But are you going to have refiners that are annoyed at Saudi, and they're going to have to say, look, you screwed us by doing this. You hurt our margins. We had to go to Russia. We had to go to others. We're not coming back to you unless you give a bigger discount. And then is that going to have to become a market share game, which is a battle on price more than anything else?
So that's the oil story, and I'm hearing it's complicated, and you're kind of 50-50. It could go up or down from here.
I think at this point, the question is do we see 55 or 50 first? I think we see 55 first. And that's going to be based on what the dollar does, based on the fact that everyone's looking at Saudi. I think China's is the big unknown. And if we look at December, they were not buyers in December. And that's what we were saying in November. We're like, hey guys, they always buy in November. They always buy the first, let's call it 10 days of December, and then they go away. Well, they went away, and they went away in size. And well, do they come back in size? And that's why when we look, Lunar New Year is going to disappoint. And if that disappoints, then are we really going to see demand? If we look at the consumer struggling in China, are they really going to purchase? And that's when we start looking at how does the supply chain look? And again, demand is finger in the wind. Everyone has their data that they point to. We're just looking at who is buying and who is selling. And the buyers are continuing to reduce their total flow. And we're seeing more come out of storage. We're seeing a little bit more of a game being played, which is going to reverberate and push back again. So if I said we went to 55 and then failed, I think that's a fair assessment. But again, it's going to come down to other factors with the dollar, inflation, and what's happening. But I think 65 is very lofty goals, and that's assuming that we have this booming economy that I just don't see.
Let's talk liquids. We've been hearing, obviously I go out for dinner in Denver, and for a time they banned indoor dining from Thanksgiving to Christmas conveniently, and now they're going back inside. But we were burning an unbelievable amount of propane to keep these restaurants able to serve anybody, to keep some of the even fragilely employed. What's going on with liquids in the world? And so I'll include propane in that, but what are you seeing? How is that market different? I think you talked about India. We're seeing some conversions of fuel, and Japan, et cetera.
So we've had a cold snap that's ripped through large parts of Asia. And that's if you just look at electricity prices, LNG prices, and then LPG, and India, just to focus on them again, we've actually seen gasoline is no longer number 2 on that list, but LPG is now number 2. And if you look at propane and natural gas, they're inherently cleaner burning than diesel, different types of distillates, as well as coal. So there you have kind of this low-hanging fruit, and we've seen a big conversion and a big pivot into some of the cleaner burning fuels. But now let's look at the U.S. So what has the U.S. had? A lot of outdoor dining, which is being supported by propane heaters. You've seen a conversion away from heating oil, which is inherently diesel based on the new regulations. So you've seen a pivot into more natural gas. You've seen a pivot into more propane, and utilizing kind of a blended view of maybe a propane fireplace, propane that integrated into the home to backstop some of the heating oil and to reduce your diesel consumption. And they're different competing components. And now that's the demand side. There's also a supply issue in the sense of with Saudi Arabia and the Middle East cutting some of their production, that's taking some of the propane out of the market. And then we have the bottlenecks at the canals, and that's driven based on lack of people due to COVID, just in terms of infections, sick time. So there's also these delays, which is pushing prices higher because you have to cover that spread to ship it into the market, which again is just going to be supportive. The only difference when I look at these different things, this is going to be sticky because I think people are starting to get used to having propane, the efficiencies of it, the effectiveness of it, and that's not something that's going to go away anytime soon. Now follow that up with the chemical moves. And China has built a significant amount of refining, a significant amount of petchem, and that is also going to support some of those liquids. And a lot of these facilities are married together, where if the refining side is going strong, they'll be weighted more refining. If the chem side is stronger, they're going to have more of the chem side, and that's going to change some feedstocks and some throughput. which again is just going to be very supportive of chemicals. And if you're part of the ESG revolution, well, you should love plastics more than anyone, because there's a ton of plastic in a lot of these green, quote unquote green technologies, and that's going to continue to support movement of liquids throughout the world.
So it sounds like you're feeling a lot more bullish on liquids and those that produce liquids. So from a pricing, you're going to see some inflation there.
Yeah.
How about natural gas? Just the pure natural gas. We've seen exports. I remember when exports weren't really even a thing, and we hit 3 BCF a day, and then we hit 6 BCF a day. Now we're at 11 BCF a day. We're seeing all-time high prices in Japan. We're seeing cold snaps. We're seeing polar vortexes. Inventories seem still pretty high. What's your take on natural gas right now?
So natural gas is going to be beholden to weather, and that's just the nature of the game. And as you have crude prices going higher, the view that we're going to get more associated gas comes out. It's natural gas is just going to struggle to see any real sticky pricing in the U.S. in general. And to think between $2.75 and $3, I think, is a fair assessment as to where this is going to go. Not to say people make a ton of money at those levels, but they're not losing as much as they are right now at $2.50. But when you look out into the world, I think that we need to find ways to get more LNG into the market, because given $30 isn't sustainable, but what is the right number? And we've been using our assessment that $6.50 to $7.50 on a delivered level into Asia is a very doable number. Now, you talked about climate change and some of these shifts. Whether or not climate change one way or the other, we're seeing a change in weather patterns, and the change in weather patterns are creating extremes. So you're getting extreme heat, you're getting extreme cold, and this is going to shift the consumption, where you're going to get essentially the shoulder seasons will be flat, but then you're going to get this massive peak. And I think the peaks are going to become harder to manage. And if you look at LNG, which obviously it's frozen or liquefied gas, very expensive. So how do you maintain some of this availability on the water? Because it is costly to do it. There is boil off and other types of costs associated with it that oil doesn't have, where an oil tanker can dance in the ocean for 6-7 months without much issue. Not to say an LNG tanker can. It's just you're gonna be bleeding off your product into the atmosphere. So there's a certain amount of concern in terms of getting it into the market, but there's still going to be enough of meat on the bone in these peak seasons to help incentivize building out some new capacity and seeing some of this long-term growth, especially as you have a means of replacing coal, a means of replacing some of the fuel oils and middle distillates to increase natural gas consumption, which is, again, coming full circle to solar, wind, and some of these other greener solutions. You still need stability. You still need base load and peak shaving, and natural gas, short cycle gas turbines still provide the optimal means for that. And that's why I think you're going to start to see that adoption increase, or at least remain sticky, and then see that adoption grow in some of the low hanging areas, specifically India, China, and other parts of Asia.
So you can learn about all that in the EIA and energy data that Mark shows, and he'll go into a lot more about exactly where levels are, how the different pads for crude oil matter, how the global floating storage matters, and you can pull all of those pieces that Mark talked about. So, Mark, anything else on your mind this week? The thing that keeps coming back to me, and where we might close today in our first pregame show for the energy and economy work that you do, is, are we in a bubble? And I know there's a lot of talk about that with Bitcoin and inflation and then deflation and valuations. How do you look at this whole world, and what does 2021 look like to you?
So we're 100% in a bubble. I have traded and invested through 2 big bubbles, 4 mini bubbles, and the beauty of being in a bubble is it's very easy to say you're in one. It's just very hard to say when it ends. And there's some of the cracks were forming in 2019, and 2019, just to go back to that, we saw trade starting to weaken in July. We saw refinery margins start to soften. And then we saw issues in the Fed when we're looking at the repo rate. And there are other components to the repo rate, but that became more of a, okay, this is it. We're really going to start to see some pain now. And then we saw some of that bleed out through December. And then obviously COVID became the bigger focal point as we headed into March. But now when we're looking at this quote unquote reflation that everybody, this narrative, I don't know what we're reflating because we never really deflated. But when you look at, okay, well, what is going to crack first? And that's when we really hone in again on China, because there's a lot of hope that is placed on the Chinese economy and the fact that they're going to lead us out of this like they did in 2014 and then really again in 2016 when we saw a huge amount of stimulus that really rode the wave through 2018. And now they're really talking about pulling back on the PBOC side. They're really talking about this, cutting back on this ever ending, if you will, stimulus that they've been pushing through and debt. And that I think is a bigger point now of where does China going to go? Because who is the buyer of last resort? And now, can Tesla hit 1,000? Sure. Can Bitcoin go to 100,000? Why not? But where are you going to go when all of a sudden somebody yells fire and you're at the back of the movie theater? And I think it's going to come down to how are we going to right the system and how are we going to see the business cycle play out as we have a lot of zombie companies, we have a lot of froth in the market, and it's going to come from multiple compression. But I think we saw some of that with the bank earnings. I think we're going to have to see some of the earnings and some of these disappointments to really start to get some rational views back into the market. Because right now, people are sitting at home, they have stimulus, and why not buy calls? And calls create this own conundrum of gamma and delta and all this hedging that has to happen. So I think the biggest one to watch is China and trade, global trade in general, because I think that the inflation indicators are pointing to something more extreme than what the Fed is talking about and what the market is pricing in. The consumer, if you ask the consumer is inflation there, they're like, oh yeah, there's inflation and it hurts a lot. So I think once you start to see that bleed into the market, that's when you're going to start to see those cracks starting to form.
So this was our first pregame show. And we asked the listeners to give us some comments because the intent is for me, the simpleton, to help tee up some of the key conversations that Mark is going to have on his show and help drive people to what matters and what they should be looking at, because no one can get out of the way of a bubble, and we don't make stock investing advice on this show, but certainly people can see it's coming. And I found, at least with the hot take of the day, that helping people mentally prepare from 2018 until 2019, that oil and gas companies were running too many rigs, growing production too fast, had a crisis of balance sheets, were going to need to merge, and it was going to lead to job losses, allowed people to better position their own personal families ahead of that move. And so if we can accomplish anything on this show, that's our goal. If you have questions on topics or need explanations, I'm here to help tee that up. And Mark, with the weekly show that he does with Primary Vision, will be able to deep dive all of this so it will make sense to you. So that is our show for this week. Mark, thanks for joining us and being here. And I guess I'm the co-host, or this part we're gonna have to figure out. Mark Rossano, David Ramsden-Wood signing off for now.
Thank you.